Hello, members, and welcome to the weekly review where we take a look at what happened last week, the implications going forward, especially as we're getting towards the end of the year here, and then also, what the fundamental technical picture looks like and how should we position our portfolios, right? I mean, that's what you're always trying to do is look at this, understand when there's too much risk versus the reward and the probability of that risk materializing, and then using that to position, right, in terms of how much you have on or don't have on. So last week, we had looked before the prior weeks and said, okay, we still don't see anything that tells us that we're going to get a pullback. We know that we can get one at any point. But there really were, not to make excuses, but, to be realistic, there really were no clues of an imminent pullback, certainly not of the size that we saw last week in the technicals until we got to that Wednesday breakdown, where we did a takeaway bar. And then we saw that confirmation of it on Thursday, suggesting that we would trade lower on Friday, and that is the way it traded out. And Friday was a particularly bad day in terms of that trade because, once it couldn't lift and once energy kept declining, there was some more serious selling coming into the market. So one of the larger moves down of the year again on a weekly basis, almost 4% on the Dow. The Russell was actually the least in terms of a decline. Russell's actually sitting at anchored support, range support, and we saw pretty good declines across the board. But you can see, energy was the one taking a hit, and companies associated with energy and debt associated with energy was where the real weakness was. So let's pop into this and pop through this. There's a lot to go over, so let's try to do our best to get through it all here. Technicals, fundamentals. If we look at it, from a quick review, that up stuff finally came to an end. We finally got a retreat. If you remember last week, I talked about we could get a 4 to 5% pullback. And what I was doing is I was looking at the weekly charts and saying, okay, where could this thing trade back to if we get a decline? And even though we had no reason to believe we were going to get the decline yet, that was the question. And so I popped over and looked at the weekly and says, okay, where could it come back to? And I know I've highlighted this before, but I'm going to highlight it again. The fact that we've come back now, before we got 6 bars, makes this I think it's about 68% on a bullish move, 68% that this thing is going to regenerate back up. Now, if you remember, we had no B point on this whole move. So we had no B point until we got to the top. So now this retrace, as it retraces, potentially can lead to a very large ABCD structure to the upside. Now that's looking on the positive side of things, right? So a retrace back could lead us to a large potential move back to the upside. And if you remember, there actually were, or still are, ABCD structures that were in place on the daily time frame supporting that notion. So we had an ABCD structure that was put in place here on the daily, led to here, back up, right? That leads to a large ABCD structure on the upside. We haven't violated this yet, but we're right at it. And so that's really going to be the test this week is can this thing break back down, nullify this large ABCD structure here on the daily, but still be potentially setting one up on the weekly. It will just have different, price targets if that happens. Now, that's the positive side. What's the negative side? Well, the negative side is if you walk around to the other side of the trade here and say, okay, this thing's coming back, and so far it's given us no ABCD structure to the downside. In other words, we don't have a B point yet on this one. So assuming we bounce at some point, right, then it's going to be all about resistance on the way back. And I know you've heard me talk before that it's not the first move off the top that kills you, it's the failed bounce that does so. And so when we're looking at this on the way back up, assuming that it gets a failed bounce, right, that's going to be the risk point. And if I look at this and say, okay, we had, kind of a range trade up here that now has broken down here and now has extended, right? You can see the extension on the range trades. It's right towards the end of that one. Question is will it do one more that will take it back into these bars, or is it going to bounce from here and then try to move back up? I don't know the answer to that. We'll talk about it a little bit more as we look at some of the other markets here. But as it moves back up, given that range that we just talked about, that's going to be the resistance as it comes back up, right? It's going to be these three bars and these three highs. So that's what you're going to look for when this thing does bounce, and I suspect it will here at some point. That's going to be the question, is does it get back over this and go back up and make new highs, or does it fail? Because the failure is the bounce, is the process that could lead to a larger move down. So, depending on how far we come, how much we bounce, that is always the structure that you're looking at. So that to me is the risk. Don't have a B point, failed bounce potentially down the road. That's using the daily chart and the weekly chart of the S&P 500. As part of that, I want to kind of point out another thing that we haven't seen any kind of bottom yet in the energy market. We don't see it here on the XLE. We don't see it on the OIH. Remember, we were looking at the XOP. There's no sign there, although it's trying. If you look at the USO, oil itself, there's no sign here. And if you look by extension to the junk bonds, there's no sign here of a bottom yet either. So the drivers of this move down have yet to even find their bottoms, which suggests that we're going to see more pressure initially off of this. So I do not expect to see a big turn back up until these markets start to find bottoms. In other words, they have to come down, they have to reach a point where the sellers are unwilling to sell at lower and lower prices. That tells you that you're washed out. Given that this is the external driver that has brought the whole market back, primarily because of what it's done to the bond market, that to me is where we have to be looking to say, okay, when this finally bottoms, when it shows us there's no more sellers at lower and lower prices, certainly not an expansion of them, which is what we've been seeing, then we can start to think about some sort of a rebound in these markets. So 45% pullback off the top, we're not that far away. If I pull back over here the S&P 500, we're not that far away from that number. That top was 2079. We're trading at roughly 2,000. So that's 79 points off. That's roughly, if I can do some quick math here, that's about a little over 3%. So 3.5% max, right? So you're off about 3.5% in the S&P 500. 4 to 5%. We're only talking another percent and a half. That also jives with what we were just talking about with the weekly, right? Coming back into this full retest regen, which is 1978. That's where I'm thinking this thing could go on this first pullback. And if you look at the news flow, Fed meeting on Wednesday, that's where it all could happen. Okay, I spent enough time on that, but that to me is the big part, kind of the big story that's going on and the things that are moving it. And if I pop back over to the notes here, that's basically what you're going to see here in this, right? I talked about the takeaway bar, that it looks to me like we're going to get some more. If I didn't pull up the Dow Jones, but if I look at the Dow Jones, This one actually broke through multiple swing points. That led to the faster move when it happened. So you came down here, you broke them, you tried to flip around, couldn't, right? That leads to a faster move. It comes right back into this big bar. The Dow already looks like it's at a point where it's going to try to hold. If I pull over at the NASDAQ and look at it, let me grab the NASDAQ here. If I look at the NASDAQ, if I can get the NASDAQ, here we go. That one has two swing point lows here, right? So this could lead, and it's only on this time frame. It's not on the weekly, but just on the daily. But if we look at that, right, the NASDAQ's coming back, and it's trying to come back into these prior highs on the weekly, whereas on the daily, it's coming back and potentially could break these two swing point lows, and actually there's another one right below it. That could lead to a faster move down. So, you know, when I look at these charts, I think Monday, Tuesday, you know, if we continue to see huge moves down in oil, we're probably going to break these lows, and we're going to get a faster move to roll to, you know, to finish out that 5% or so move. If we don't, right, then we get a little bit more, and then we see the bounce. So I suspect we're kind of close. That's the way they line up here. It's just a question: are we going to get another 1.5%, 2%, or have we pretty much seen what we're going to see? Right? Maybe another 0.5% down on Monday. That's kind of the way those things set up and they look. Popping over to the rest of the notes here. You know, I talked about that worst case. I've kind of beat that to death, so I'm not going to go on that. Energy really, to me, was the driver, and I've already emphasized that. If I look at the positive side, you know, that range that we talked about, we're into it already. We're already into it on the weekly chart. We're doing the retest regen. Has a reasonably high probability of succeeding, and so you have to kind of think that's going to happen. And you have that same situation on all these others, which I've just shown you. I didn't show the Russell. Let's look at the Russell real quick now. Now the Russell was the one that held up the best last week, but that wasn't because it was the strongest. It's because of the technical setup, right? You have a range trade here, right? It came down to the bottom of the range and held it. If we see further pressure tomorrow, especially if we see that faster move develop as a result of oil and energy plowing lower, if that does take place, it's probably going to take the NDX lower. This is going to break, and there's a bunch of stops up underneath here. It's going to take it in towards the bottom of this bar. I would expect you'll get a range trade breakout. There's two things we could do. One is we could put a tight stop up here because we're actually in the IWM. We could put a tight stop up here and try to buy it back cheaper. Problem with that is we may just see a washout right up here and get stopped out and never get back in. Or we can play it safer and say, okay, we're going to move that third entry instead of up here, move it down into this price area and put our stops lower. And as you'll see in the portfolio, that's the way I chose to do it. So there's always ways to play these things. We have to take a little bit more risk by doing it this way. The assumption being, if we get this faster move down, right, it's going to make the probability of a bounce even higher with demand coming in. And so I think that's probably the higher probability bet, right, to make money. And so that's kind of what's leading me to go that way. And we don't have that much. You know, if you look at the portfolio is only about 44% invested. You know, we've done our best to make money off this move higher without taking a lot of risk. You know, I made a couple of buys. I probably, you know, looking back at them, I probably would have done it a little bit different. But for the most part, AWK being one of them. But for the most part, you know, we've been very patient about how we played these trades and what we got into, and making sure that we took some profits as they moved higher. And we'll see that, you know, a little bit more when we go to the portfolios. Now it's a different market in that we're finally getting some retrace. That first retrace is usually the one you want to buy, and that's what we have to be thinking. Okay, so that's where the thought process is, and that's the Russell and how the Russell lines up. On the positive side, you know, it's those things that we should be thinking about. Europe is in this large range trade right now. If I pull up say, let's just pull up the DAX, you can see how they got a hard sell down on Friday. This has come down quite a bit off the highs and is back into the bottom of this bar. And you're going to see when I go to the portfolio portion of the talk here, you're going to see me thinking about buying into the DAX, and I'll show you how we're going to try to do that. So Europe still looks okay. China's been strong, still strong. Looks to me like world markets, other than higher risk emerging markets, are still doing all right and therefore not hugely worrisome at this point. Pulling, I want to come back one more time, and I'll just use the S&P 500. And what I want to do is I want to bring this back, and I want to put this on a monthly, because you got to have context. We've had a huge run, right? And off this low in October, we had a huge move off of it. And it might even be easier. So, the point is here is that this has been a strong move to the top side. Now, we know at some point that will end, but if you look at this move off of October, to come back this far, even though last week was a big down week, look at the context of how far we've come. This is normal. This is what you would expect at some point, right? You just don't know when it's going to happen, and unfortunately, it doesn't always give you the best clues that it's now. If it did, then we could always jump all in, all out, but you don't usually get that clear cut of a clue. And if you remember last week, we really had no clues other than energy struggling as it was, that this market had anything on a hugely negative side other than the fact that it was extremely extended. We knew that, and we knew we could get a pullback. Now that we're getting it, it's normal. This is not abnormal. So I wouldn't reach the point or the conclusion of freaking out about it. And it's hard not to when you see big declines. But in the context of the move that has taken place, it's what should happen. It's not abnormal for this to take place. And I just want to emphasize, that is the case. On the fundamental side, it's the same thing we've seen. The central bankers, we got the Fed meeting this week, an announcement. We already know that they're discounting, that language being taken out of the statement, the considerable period of time language. We're going to have a press conference afterwards as well. So that, all of that is, I think, to some degree factored in, and how that press conference goes and how the Fed head tells us, is she still leaning dovish or has she turned hawkish is going to be the key. And I can't believe she's going to talk about being hawkish. I think it's going to be more dovish, and that's probably going to be a buy the news type situation. We're 1 month away now from the earnings season, and so far there's really not much in the way of earnings. We've seen a few, but not very many. So that actually is a positive as well. On the fundamental negatives, right, you got to talk about oil and energy. It's a commodity. At some point it's going to find value, but right now it hasn't. And even though it's really oversold, until you see somebody come in there and start thinking, okay, now it's the bottom, and you see no more sellers, you just don't know where it's going to end. And so at this point, that's still a negative. And that move into commodity is bleeding over. And those fast moves are what creates the volatility, and that is what we've seen, and that's a negative. This debacle's put a lot of pressure on corporate bonds, especially the junk bonds. That also raises fear levels, and that's a big negative that we've been seeing. What would I be watching for? I'm watching for a reversal. I watched for it all week in the TNT room. We never got it. I kept talking about it. And until we get it, I don't think these markets can lift. They're hostage to this situation. There is the potential for some sort of a buy the news off the Fed announcement, especially if we sell down more into it. I think it increases the probabilities quite a bit. And this test of the prior highs on the weeklies, it's important that those hold for us to stay in a very bullish mode. So as we see it come back and those tests take place, if they do not hold, what does that tell us? That tells us it's a range trade on the intermediate term time frame versus a bullish trade. And that's a big difference, and that will change our outlook if that's what's happening. But for now, if they do hold, and that's what we should be watching, that says we're still in a bull market mode. Upcoming, the Fed is what I've talked about, but there's a lot of other data this week. You've got PMIs, you've got some announcements in Japan as well. I just saw that the election went off in Japan and Abe won, so that continuation of that policy, you have to expect that's going to continue. You got Philly Fed, you got LEIs, you got a bunch of PMIs. There's a lot of data. Plus, you got quadruple witching on Friday, which will put some volatility, because honestly, Friday is the last big day for volume. Monday, Tuesday next week, the following week, there's going to be almost nothing, and there's going to be almost nothing until the end of the year. So next week really is it for the volume side, and that quadruple witching is going to kind of cap it off. Geopolitically, oil crumbling like it is puts a lot of pressure on some of these countries, in particular Iran, Venezuela, and Russia. I've talked about the Russia connection already. We've got the Senate threatening to put more sanctions on Russia. If they do, Russia's going to retaliate. As long as that continues, that's a problem, and it's going to continue to be a problem. So, watch that on the geopolitical side. So what's the bottom line? There's the potential for a failure. Last week we talked about with the divergence, and it actually actualized. So we saw, if we pop back over here to say the NASDAQ composite, right? We had that potential. Remember last week I was talking about this high. Let me get a different tool. We were talking about this high and the inability to get over and stay over that high being an issue. Well, it tested it 4 different days, could not do it. We come down, we pop right back up into the range. Remember the range here? That was this bar. And then we did the takeaway bar. So that potential breakdown finally actualized here on Wednesday. On Thursday, it was confirmed, which led to the Friday declines. Now we're at these swing point lows. Now we're at that critical point I've talked about. But that was how it set up last week. And that potential breakdown actually took place, and now it's got a real retreat as a result. My view is that we're way overdue for this, and we've refrained as best we could from getting too enthusiastic and putting too much money to work at the highs. That's always a dangerous thing, and it's hard to fight that. As the market goes up and up and up, you just feel like you have to buy. And you have to do your best not to do that. Retraces do occur, and it's the retraces you want to buy versus putting your money to work when the market's already up 15%. I mean, it's hard to do. You have to keep rotating that money, making as much as you can, but staying out of the position of I've got 80% of my funds invested when I'm at the highs. I only want 30 or 40 and try to put 30 or 40 more back on when it retraces, which is what we're facing now. So at this stage, think about where we are in this market. We have a bullish market that's retracing. We know that the result of this, right, the potential result of this, is that our MTTFs now have started to move more to the overbought, we're at 62% now, than they are on the oversold. So we know that we're farther along in the move. In other words, we're getting towards the end. When you get towards the end of a leg, you don't want as much exposure in the individual stocks, but instead in those things that are broader, especially if it lines up with earnings, because earnings are only about 4 weeks away. So the potential for negative announcements in individual stocks and being hit by those is greater, and the potential for pullbacks in individual stocks in terms of how far they pull back percentage-wise is also greater. So we want to move towards being invested in the indexes, right, not in the individual stocks for those reasons. And so this week in the portfolio, you're going to see me do exactly that. We're going to look at these things to buy into versus adding more to individual stocks. We have enough in the individual stocks. As a matter of fact, we want to see that bounce take place and allow us to take profits in those individual stocks that are trades, right, and work our way out of those positions over the next 2-3 weeks rather than staying in them and taking the risk of being hit on earnings or on a general market decline. Last week, busy week, a lot of things. We went in, got out, got back in. We're lightly positioned, but we have money on the table. I think we want to add to it on this retrace and try to pick those spots to do so. We have the IWM on, the SOX on. We've gotten out of the VUG. We've gotten out of the XLY, took our profits. This is where we should focus. We've already got positions started there, and we should focus on these two as well on an overseas. That will give us domestic and overseas exposure, and we're trying to go into those areas that we know the central banks are supporting the markets, and we're going into the areas that have actually held up better of late, which is the SOX and the IWM. We already have exposure through Apple and through Google on the big cap technology, so I don't want to go into Qs or anything else. We already have enough exposure there, and so we're trying to round it out. I've highlighted 4 stocks. You can read all about the rest of them. I've detailed my thoughts there, but I want to highlight these 4, and I want to look at these 4 with you because I think these are the ones that focus on where we're trying to go, and then B, also shed as much light as possible on my thinking here. So I want to look at HEDJ. One of the things I've talked about recently is if you're going to go into overseas stocks with the dollar strong, you want to try to take the currency out of it. HDJ is a way to do that with the German market. As this comes back into this support zone, this is about a halfway move on the way back. So we made the highs here, we had the lows there, about halfway back is here, which is where the support is. And if you look at the volumes coming back, not only here but in the German DAX itself, they're coming back into a support zone that has higher volume. This is the place to try to pick it up. You're going to see an order in the markets tomorrow for this, and we'll try to add exposure in the strongest of the markets, the countries in Europe where the ECB, everybody at least believes, is going to have to support some sort of QE program. And so if they do that, this market is going to rally, and it's going to rally hard. That's the HEDJ. Let's look at the others. Let's see here. Let's go to the DXJ, which is the other overseas market. So of course this is Japan. Again, if you look at this, you've got big support in this area from these bars, and as it comes back into this is the area. Now there is a little ABCD structure that has formed that may trigger, and if it does, it's going to take it right to the bottom into this gap area. So we've already bought one order of DXJ. I've got another order in for whenever it comes in, and I've moved it down to this 5311 area, which is down in here off this ABCD structure. May have to adjust that, but that's the thinking there. Now going to the domestic markets, and let's look at the IWM. As I already talked about, that range trade breakout or breakdown is possible. It's in this area. That could take us down as low as here, and so you're going to see the last order down in this area and a stop underneath it. And I've already talked about it quite a bit, so I'm not going to belabor that much more. And then of course the last one is actually a big cap. I'm not going to highlight the SOX because you kind of know where the scenario is there, but I'm going to look at Apple because Apple had a trade down now twice, had an ABCD structure off this high that it finished here. Now it's got to bounce off of that and another potential one to take it lower. There is support here. It's come back with pretty good volume, right, compared to what was there. We could come all the way back. That would be an ABCD structure, another one even on top of this. We could come back to here. We already took a position. I don't want to add to it yet. I want to see how it trades. Apple, of course, is drifting back in. Volume's not heavy. It's probably going to have a good earnings season, but everybody already knows that. If we buy it again, we probably buy it back into the support zone. If we get a push back up, depending on how that develops, if the whole market moves back up, we could see it trade right back to the highs where it came off with volume. That's where we'd want to actually, because that's where we want to take the profits, because that's where the breakdown bar is. So the idea is to try to take some profits up here. If we have to, we wait, we buy down here again. But in the meantime, we're just watching to see what it wants to do with this area, and do we get that big bounce in the markets and in this. If the markets make new high, Apple will make new highs, or at least will test that high. And that's what we're looking for. And before I stop, let me quickly look at the SOX, because I talked about it. The SOX has a nice structure to the upside. It's pulling back. We sold some out on this bar, actually. We're back to it. We're going to be able to buy it back cheaper. It's got a swing point high over here. It's coming back into. It's coming back in with more volume. It will be the first retest of that. I expect it to regenerate higher. Therefore, I want to look at a buy in this area. And so that's the SOX. And you see an order in for it around, right now I've got it, I think, at 88.31. Okay, a lot of material. Sorry for it taking so long, but I wanted to wrap it all up as best I could. I'm not fearful of what these markets are doing. I don't think you should be either. What we should see is this as an opportunity for us to finally put some money to work again, and to trade it higher on the idea that we'll get that Santa Claus rally over the next 2 to 3 weeks on some sort of low volume push, which is typical this time of the year. Folks, have a great one. Thanks. I'll see you later.